Is Visa just a plastic card in your wallet, or is it becoming the invisible engine of the entire global economy? Right now, the market is pricing Visa around $326, but what if I told you the real intrinsic value is sitting closer to $388? That is a potential 18% upside that most investors are overlooking because they think Visa is just a legacy payment company. Today, we are breaking down a strategic valuation that changes the narrative. From AI integration to stablecoin settlements, we're going to look at the math, the moat, and one massive geopolitical risk that nobody is talking about. Let's dive in. Hi everyone, I'm Lynn. Welcome back to the channel where we decode institutional level research for your portfolio. So the rating we're looking at today is overweight or a moderate buy. The timeline, the next 12 to 24 months. Here's the core thesis. Visa is evolving from a card network into the core settlement layer for the future of digital commerce. They aren't just competing with fintechs, they are co-opting them. They are building a fortress with cloud and AI technology that makes their moat wider than ever. Now, getting this level of clarity on a mega cap stock usually takes weeks of digging, but today's deep dive is actually powered by ALPHAPILOT. It's an advanced AI investment analyst that helps me generate institutional grade research and valuation models like the one we're using today. It saves me hours of work while delivering precise financial insights. So let's use their data to look at why Visa is mispriced. The market thinks Visa's growth is just about people switching from cash to cards. That's the old story. The new story is about three things. One, cloud integration. Visa's Cloud Connect is allowing fintechs and neobanks to plug directly into VisaNet without massive physical infrastructure. This lowers the barrier to entry and locks partners in. Two, the agentic economy. Visa is partnering with AWS to use AI not just for fraud detection, but for agentic commerce. Imagine AI agents buying and selling for you securely. They are preparing for a machine-to-machine economy. Three, crypto and B2B. They are aggressively entering stablecoin settlement flows. This isn't hype. It's about capturing high-margin cross-border B2B payments that traditional banks are too slow to handle. Okay, let's talk numbers. Is the stock actually cheap? We ran a discounted cash flow analysis. We used a WACC of 6.64%, which is very precise given the current 10-year treasury yields, and modeled a 5-year growth trajectory. The DCF baseline gives us an intrinsic value of $370.60. When we cross-check this with relative valuation, looking at PE ratios compared to peers, we get a fair value range between $260 and $375. But here is the kicker. We added a 3.5% qualitative adjustment to the price. Why? Because the DCF doesn't fully capture the optionality of those new AI and stablecoin revenue streams I just mentioned. Bottom line, our final target price is $388.13. However, I need to be transparent about the risks. It's not all sunshine. Beyond the usual regulation issues, there's a specific geopolitical risk emerging. Visa recently announced plans to potentially launch operations in Syria to help develop their digital payment ecosystem. While this opens a new market, it's a compliance minefield involving sanctions and strict OFAC regulations. If this goes wrong, the reputational damage could be significant. It's the one wild card you need to watch. So here's the verdict. Visa is a high-quality compounder trading at a dislocation to its fair value. With an 18% upside to our $388 target, it's a solid defensive play that still offers growth. If you're a long-term investor, any pullback into the 300 range is a gift. But I want to hear from you. Do you think Visa can win the war against digital wallets, or are they destined to be disrupted? Drop a comment below. If you enjoyed this breakdown, smash that like button, and I'll see you in the next video.